The money in your bank account is an illusion. You think you own it. You do not. It is merely an unsecured loan to a highly leveraged institution. But that is just the tip of the iceberg. The entire global economy runs on a hidden, parallel currency system that the Federal Reserve cannot control, cannot regulate, and cannot rescue. This is the cold, hard reality of the international banking system. To survive the coming macroeconomic transition, you must understand how the global elite actually move capital. Most retail investors look at interest rates, inflation, and the stock market. They are looking at the puppet, not the puppeteer. The real power lies in a shadow financial network that controls trillions of dollars in daily transactions, completely undetected by the average citizen. By the end of this video, everything you think you know about money will be shattered. We will expose the mechanics of this hidden machine. And, most importantly, we will reveal the collateral multiplying matrix. This is the precise, three-step blueprint used by sovereign wealth funds and ultra-high net worth families to build generational empires during periods of systemic liquidity freezes. It is a tool designed to turn global crises into personal printing presses. But to understand how to exploit this system, we first must tear down the illusion of money itself. Let us start with a simple question. What is a dollar? If you ask a Treasury secretary, they will point to a green piece of paper. If you ask a commercial banker, they will point to a digital balance on a computer screen. Both answers are fundamentally wrong. The vast majority of the world's transactional currency does not exist in the United States. It exists offshore. This is the Eurodollar market. Despite the name, Eurodollars have nothing to do with the European currency. A Eurodollar is simply a US dollar-denominated deposit held in a bank outside of the United States. These banks are not subject to the Federal Reserve's reserve requirements. They do not report to the Federal Deposit Insurance Corporation. They operate in a regulatory vacuum. This offshore ledger system was born during the Cold War. The Soviet Union wanted to hold US dollars but feared American asset freezes. To mitigate this, they deposited dollars in British banks outside US jurisdiction. This created a parallel, offshore ledger system that exploded as globalization accelerated. Think about the scale of this. The Federal Reserve does not even know how many Eurodollars exist. They stopped trying to measure M3 money supply decades ago because the shadow banking system had grown too complex to track. The Fed is essentially driving a high-speed vehicle down a winding mountain road while wearing a blindfold. They control domestic interest rates, yes. But they do not control global liquidity. When the global financial system screams for dollars, it is not screaming for physical cash. It is screaming for balance sheet space. Modern global trade is not financed by central bank printing presses. It is fueled by private commercial banks expanding their ledger systems across international borders. When these banks trust each other, credit flows freely, businesses expand, and asset prices skyrocket. But when that trust evaporates, the entire global machine grinds to a halt. This brings us to the core engine of the shadow financial system. The repo market. Repo is short for repurchase agreement. It is the hidden plumbing where major financial institutions lend each other trillions of dollars overnight. Here is how it works. Bank A needs cash for 12 hours to meet its regulatory requirements. Bank B has excess cash. Bank A hands Bank B a high-quality financial asset, usually a U.S. Treasury bond, as collateral. Bank B hands Bank A the cash. The next morning, the transaction is reversed. This seems incredibly simple. It is not. In the modern financial system, Treasury bonds are not just government debt. They are the pristine collateral that serves as the lifeblood of global finance. They are, in fact, the real global currency. Cash is trash. Collateral is king. Without a constant flow of pristine collateral, the shadow banking system starves. But here is the danger. Financial institutions do not just let that collateral sit in a vault. They reuse it. This is a process known as rehypothecation. Imagine Bank A gives a treasury bond to Bank B. Bank B then uses that exact same treasury bond as collateral to borrow money from Bank C. Bank C then takes that same bond and pledges it to Bank D. This single piece of collateral now backs multiple distinct loans simultaneously. This is what economists call collateral velocity. When times are good, high collateral velocity creates a massive expansion of global liquidity. But when risk rises, the chain snaps. If one bank defaults, the entire house of cards collapses instantly. Collateral velocity drops to zero. Suddenly, a massive shortage of pristine collateral triggers a systemic freeze. Banks stop lending, hoard assets, and markets crash. This happened in 2008, in March 2020, and it is quietly happening today. The Federal Reserve steps in by buying bonds and lowering rates. But quantitative easing does not put money into the real economy. It merely swaps high-quality collateral with central bank reserves on bank balance sheets. But commercial banks cannot use central bank reserves in the offshore eurodollar market. The Fed's intervention actually strips the system of the very collateral it desperately needs to function. It is like trying to cure a dehydration crisis by feeding the patient salt. The global elite understand this paradox. They do not panic when the market crashes. They anticipate the liquidity squeeze. They position themselves to profit from the structural flaws of a system that is constantly starved of its own lifeblood. How do they do this? They bypass retail financial vehicles entirely. To join them, you must shift your focus from chasing yield to controlling liquidity. In a debt-based monetary system, liquidity is the ultimate weapon. When it dries up, everything goes on sale. The person who controls pristine collateral during a margin call dominates the market. First, they build an asymmetric liquidity reserve. Most investors keep emergency funds in savings accounts. The elite hold pristine collateral directly. They buy short-term treasury bills not for yield, but for utility as transactional assets. In times of stress, these bills are weaponized, pledged, or used to secure favorable financing when others face liquidation. Second, they focus on hard, cash-generating assets with structural inelasticity. These are assets that society cannot function without, regardless of the macroeconomic environment. Think of critical infrastructure, logistics hubs, defensive real estate, and essential commodities. These assets act as natural inflation hedges while constantly spitting out yield. When the shadow banking system chokes, these assets remain resilient because their demand is decoupled from financial market speculation. Third, they master non-recourse debt architecture. When average people borrow, they accept personal liability. If things go wrong, banks seize their wealth. The elite use complex corporate structures and special-purpose vehicles to isolate debt. If a project fails during a liquidity freeze, the damage is contained. Their core wealth remains completely untouched. This brings us to the moment of revelation. The culmination of this entire economic journey. We have established that the global financial system is built on a fragile foundation of offshore ledgers, rehypothecated collateral, and central bank intervention that often worsens the very crises it attempts to solve. The system is inherently cyclical. It breathes in credit expansion and breathes out violent liquidity contractions. To not only survive this cycle but to exponentially multiply your wealth within it, you must deploy the tool we teased at the very beginning of this video. The collateral multiplying matrix. This is the ultimate wealth framework used by the ultra-wealthy to exploit systemic crises. It operates on three distinct levels. Phase 1 is collateral acquisition. During periods of artificial credit expansion, when interest rates are low and confidence is high, the elite aggressively accumulate pristine, highly liquid collateral. They do not chase speculative tech stocks or volatile cryptocurrencies. They focus on securing institutional-grade assets that the shadow banking system recognizes as Tier 1 capital. Phase 2 is synthetic leverage. Once this base of pristine collateral is secured, they do not let it sit idle. They use the repo market mechanics to their own advantage. By pledging this collateral, they secure low-cost, long-term financing. But they do not use this financing to buy consumer goods. They use it to acquire undervalued, cash-flowing real-world assets. The cash flow from these real-world assets easily services the low-cost debt, creating a self-sustaining, positive carry engine. Phase 3 is the liquidity arbitrage. When the credit cycle turns and a shadow banking freeze occurs, asset prices plummet. Because our elite investors hold pristine collateral and isolated debt, they are immune to the panic. They have clean balance sheets. They use their collateral to secure emergency funding, acquiring distressed generational assets for pennies on the dollar. When the central bank inevitably floods the system with reserves to restart the engine, the value of these assets explodes. This is how the rich get richer. It is not due to hard work, superior intelligence, or luck. It is the natural mathematical result of understanding the hidden plumbing of the global monetary system and positioning oneself on the right side of the liquidity ledger. The next global economic transition is already underway. The tectonic plates of the geopolitical and financial worlds are shifting. The eurodollar system is fracturing. Most people will be caught unprepared, watching their savings lose value. But for those who understand the true nature of global liquidity, this represents the greatest wealth transfer in human history. By shifting your focus away from the superficial headlines of mainstream financial media and deeply studying the mechanics of shadow banking, repo markets, and collateral velocity, you position yourself to be a creator of wealth, not a victim of inflation. The choice is yours. You can remain passive, believing the comforting lies of central planners and domestic banking cartels. Or you can take control, master the rules of the hidden system, and deploy the precise frameworks necessary to build an empire of generational wealth. If you want to master these advanced strategies and stay ahead of the curve, you must understand that the money in your bank account is an illusion.